Hello, and welcome to another edition of Lodging on Demand. In this episode, Lodging Editor-in-Chief Dennis Nessler sits with Brian Quinn, Chief Development Officer at Sonesta Hotels International, and Tim Muir, Chief Development Officer at TPG Hotels Resorts, to discuss the recent interest rate cuts and their potential impact on transactions. The development veterans also address new build activity and what they see ahead for the rest of the year and for 2025.
Hi, this is Dennis Nessler, Editor-in-Chief of Lodging Magazine. Welcome to our podcast today. We are going to talk a little bit about interest rates and the recent cuts and what that impact will be on development for the hotel universe. We have a couple of experts with us today to discuss it. We have Brian Quinn, Chief Development Officer for Sonesta International Hotels, and we have Tim Muir, Chief Development Officer for TPG Hotels and Resorts. Welcome, boys.
Thank you.
Thank you. Nice to be welcome, Dennis. Good to see you, Brian.
To Tim.
So, guys, let's get right into it. What do you think the impact will be? Transaction activity has been pretty much stalled for the last couple of years. The Fed cut interest rates by 50 basis points, possibly some more cuts coming down the line. Do you think this is going to have a material impact? Brian, you want to start?
Yeah, thanks. I mean, look, it was. I would say that the Fed was a bit late. I wish they would have done the first cut in August, especially after the assassination attempt and the trade out of Biden and Harris, just to keep the consumer sort of in line and continuing to spend. Cuts are better than increases. That rate changes a lot of things. Lower borrowing costs, hopefully a boost or a stabilization in consumer spending. Easier refinancing options, but we need, some consecutive cuts in order for the market to form back up in a way where it'll unlock the transactions. We're on the right path. I mean, it's the first cut in 4 years, but the high rates, and this impacted Tim's side of the business and mine, had a dramatic reduction in the trades, right? The bid and the ask was off anyway. The market was stabilizing post the pandemic, and then to have the increase in rates really, sort of gummed up the works.
Rates, I like Brian said, I'd like to see a second and third cut, and you got to see transactions. We're not seeing enough transactions between buyer and seller. Things are moving slowly. I'm an optimistic person, but what my experience tells me is we need more, and I think we'll hopefully see that in 25 and 26.
Yeah, I think Tim's spot on it. You have a dynamic where the high rates, coupled with the supply chain issues and the inflation, really forestalled a lot of new construction. And then on the trade, when the trades happen, think about what that transaction does for our industry, right? So you have a buyer and a seller, right? So you've got everyone that's supporting that transaction rewarded in the system. And then also that's when the brand changes happen. That's when the PIPs get done. That's when the refis get done. All of that was also stalled. So the path we're on to a reduction in the interest rates will help both the new construction side and the trade side. But borrowing costs were just so out of whack. And then, as I mentioned, coupled with the inflation around the new construction expense and the tail end of the supply chain issues, really just created a dynamic where there wasn't explosive growth. I think as a brand company, it's incumbent on us to continue to look at the standards and look at the prototypes and come to market with products that make sense. And everyone is value engineering, because the only way we're going to unlock the growth potential that we all know exists, right? We've lived through some of the other cycles, is that you've got to get the cost down to a point where the returns are there, the flow-throughs are there to attract the equity so they can get the return. And so debt has the confidence to put the money out the door.
Yeah. What areas of construction costs are really where you are seeing the most inflation? Is there anything specific in terms of materials or labor, or what are you guys seeing there?
So I'm seeing a 10% higher cost on the hard cost. So on the bids that we're getting from the contractors. So you look at your hard, your soft, your FF&E, and your land. Construction costs, have gone up considerably in the last couple of years. And just comparing to some of the properties we broke ground in 2023 and what we broke ground in 2024, it's about 10% more than what it was in 2023. So
Yeah, I agree with that. I think, we're doing a significant renovation rollout across the U.S. Put out about $600 million over the next 36 months to renovate the hotels. And one dynamic, two green shoots here. One is, I think the contractors, the vendors, the suppliers, they understand we're in a constrained environment, that we've stretched outside the normal business model. So when we've gone back and asked them to sharpen the pencil and help us look at the VE potential, they've been more open to that conversation than maybe a year and a half ago or 2 years ago, where they were just pushing back. They were so busy, and everybody was ramping back up, that there really wasn't an ability to have that conversation, and that conversation is happening. And we have seen a few projects be rebid where some elements have come down. I think around labor, we're going to see a little bit of negotiation and a little bit of buying power coming to the developer, just as unemployment softens just a bit. I don't think it's going to soften much, but we've got to bring all the skill sets to the projects to figure out how to make them go projects if we want to grow. And I was just finishing up a session around the consumer here in West Palm Beach, and the consumer wants new, whether it's newly renovated or new product, and the consumer has changed, right? They're sensitive to design, to music, to beverage, to experiential, and we've got to pull that through the hotels, and that costs money, to Tim's point. So we've got to figure out a way to be able to execute on it. The other thing that the drop in rates does do is it creates a boost in consumer spending usually, and some confidence, for the consumer to continue to go out and buy lodging, which is critical, especially as we wiggle through the next, 45 to 75 days to get through the election. But money is not cheap right now.
Looking, I know it's been largely a conversion market, in terms of growth for the last few years. Do you see that changing at all anytime soon, or kind of status quo right there?
So, if you look at the last couple of years, like 21, 22 was more of a seller's market than a buyer's market. New construction, deals are getting done, but they're getting done at a different cap stack of 40% equity. The bank or the lending relationships are typically someone you have a long relationship with 20, 30, 40, 50 years. We're still building. But we're building 1 or 2 properties a year, probably, rather than 6 or 7.
Mm-hmm.
I do see it as the market kind of shifting now, coming into a buyer's market more than a seller's market. I think the biggest challenge that we've had is buyer and seller couldn't agree on price, and that's why they haven't had a lot of transactions. Although deals are getting done, I like to see it at a higher scale. I think the industry is good. When brokers are busy, banks are lending money, developers are building, and markets are growing. But a couple of things have to fall into each bucket. The transaction bucket, I would say, would be 1. Lower debt would be number 2, and construction costs drop, or at least sharpening the pencil where we could get better bids, more competitively in markets that we want to build. So those 3 things, when they align, it'll accelerate growth. And, right now, like, nothing in the business moves quick. They typically move in cycles. But, I think we're headed in the right direction. In the last 2 years, we probably underwrote maybe 150 deals, came across our desk, and we probably transacted on 5%, which it's not bad. But we've been swinging a lot of pitches. You just have to remain patient, stick to the fundamentals. Let the market come to you. Don't press, where it's not there. And I think in the next 12 to 18 to 24 months, we'll be in a different cycle, and the conversation we're having today will be a lot different.
Yeah, I agree with Tim. I think, hiring a company like Tim's, having a professional operator is becoming more and more critical, right? There's a science and an art to hospitality, but more and more around the tech pack and around customer acquisition and scale. Having, a great operator is critical to hitting your flow throughs and hitting your returns. I think it's incumbent on the brands to also, take the standards manual out and take a look at it, right? Because we're an owner and operator as well, and have that owner's lens to franchising. We don't think it's right to put a standards manual out that says create a living wall at your front desk, and on page 26 of the standards manual say keep pests and rodents out of the hotel, right? Those two things are in conflict.
Yeah.
So let's be rational with the standards. Let's not ask our operator partners and our development partners to spend money on things that aren't critical. But the things that are mission critical, again, I think it is design, it's beverage, it's music, it's experiences. People are managing and expecting different things from their time when they're on the road. And if you deliver on them, you'll get a rate premium. I think, Tim and I have been at this for a while. This is the first time that the equity and debt recognizes the power of a lot of the hotels that Tim's group runs in that upscale lifestyle and luxury space. They're giving you upside because they know you can drive rate in that space. If you've got the design right, if you've got the food and beverage offering right, if you're in the right places, there's a reason to stay there Wednesday and Thursday, but also a reason to stay there Friday and Saturday. And those hotels will win. And that was not always the case. The debt and equity didn't really understand that space, and it took a lot of effort and time. But if you look at what continues to perform well, that higher tier continues to perform well. If you look at the wealth effect in the top 15%, did very well through equities and through the post-pandemic period here. They want to travel, but they have pretty high expectations on the road. So our products like the James and Royal Sonesta and Classico really sensitive to making sure we're meeting the consumer. And that's a good place to spend money, not necessarily a good place to spend money. You don't need to put a framed picture of Tim or I in your lobby in order to be a great hotel. You need to make sure you're taking care of what the consumer needs.
But it would make you smile every day. Gentlemen, thanks so much for your time today and your insights. A lot of great takeaways from this, and really appreciate it. Thanks so much.
Thank you, Dennis.
Thanks, Dennis. Good to see you, Tim.
Good seeing you, Brian. Bye-bye.
Safe, everyone.
Thank you for listening to Lodging on Demand. If you would like more content like this, please subscribe to Lodging Magazine on YouTube. You can also subscribe to Lodging on Demand wherever you get your podcasts. For news and updates, follow at Lodging Magazine on LinkedIn, Facebook, Instagram, and X. Or visit us at lodgingmagazine.com.